You wake up expecting payday, and your phone confirms that this month's salary has finally arrived in your account. Everything looks normal until you notice the deposited amount feels smaller than the salary you expected to receive today. Before your salary reached your account, taxes had already reduced the amount available for you to actually spend. A business report mentions that one billionaire legally paid surprisingly little tax despite earning enormous amounts of wealth recently. Curious, you discover multiple trusted reports describing similar stories involving wealthy individuals paying remarkably small amounts of tax legally. Looking across the city, you begin wondering whether something much larger exists behind these surprising financial headlines today. You pay taxes before touching your salary, yet some billionaires legally seem to experience something completely different instead. How can two people earn money under different rules if both operate inside the same financial system? Your salary begins as one number, but reaches your account as another after mandatory tax deductions are applied. Buying everyday groceries feels routine, yet taxes quietly become part of almost every purchase you make today. A closer look at the receipt reveals part of your payment wasn't for groceries alone, but also included consumption taxes. Even filling your fuel tank includes taxes that quietly increase the amount you pay before leaving the station. Lunch costs more than the menu price because taxes become part of nearly every restaurant payment you make. Monthly utility bills include more than electricity or water because taxes quietly become another unavoidable part of household expenses. Owning property introduces another form of taxation that arrives every year, regardless of how often you use the building. Businesses collect taxes from customers while also paying their own, creating responsibilities beyond simply earning daily revenue together. Many public services surrounding you every day exist because governments use tax revenue to build and maintain shared infrastructure. Without noticing, your entire day has been surrounded by taxes long before anyone mentions billionaires or global finance. Even unexpected medical purchases often include taxes, quietly increasing costs during moments when you simply need essential care. A simple electronic accessory costs more than its listed price because taxes become part of everyday consumer purchases too. Keeping your home connected involves regular payments where taxes quietly remain included within many essential monthly services. Buying something as ordinary as clothing means another purchase where taxes quietly become part of the final amount paid. Behind every small business, owners also calculate and pay taxes before they can measure what they actually earned. Some taxes aren't collected automatically because citizens pay them directly through government offices every single year instead. Hospitals, emergency care, and public services continue operating because governments collect tax revenue from millions of everyday transactions. Roads improve over time because governments continuously reinvest collected tax revenue into public infrastructure across entire communities. Whether you notice them or not, taxes quietly follow almost every ordinary decision made throughout an average day of life. If paying taxes feels unavoidable for everyone, why do some people seem to follow an entirely different financial reality? The story stays on your mind because paying unusually little tax doesn't sound like an isolated financial accident anymore. Business news constantly follows billionaires, yet discussions about their tax payments appear almost as frequently as their wealth. Some companies earn revenues larger than entire countries, making their financial decisions important far beyond individual businesses alone. Despite enormous profits, some companies reportedly paid far less tax than many people expected they would owe. The topic isn't limited to financial experts because ordinary people have started questioning these reports during everyday conversations too. New headlines continue appearing, suggesting the pattern extends beyond one billionaire or one successful multinational company alone. Everywhere you look, people seem to encounter the same stories, making curiosity spread far beyond financial professionals today. Different publications describe remarkably similar situations, suggesting these reports are connected instead of completely unrelated financial events altogether. One report might be coincidence, but several independent reports begin forming a much larger unanswered financial picture together. The companies look completely different, yet one surprising pattern quietly appears across nearly every major financial story. Behind these office towers are businesses operating across dozens of countries, employing thousands of people around the world today. Companies this large generate extraordinary profits, making every financial decision potentially significant for governments and ordinary taxpayers everywhere. Television debates reveal growing public disagreement, with some arguing everything remains legal, while others strongly question the entire system. Curiosity becomes impossible to ignore, because one simple question refuses to leave your mind after everything you've discovered. The more answers you find, the more complicated the mystery appears, instead of becoming easier to understand completely. If billionaires and global companies legally pay less tax, what rules are they using that everyone else isn't? Before asking who pays taxes, it's worth asking why governments collect them in the first place every year. Roads don't repair themselves because governments hire workers, purchase materials, and maintain transportation using public tax revenue. Every safe journey depends on infrastructure that requires continuous funding long after the roads were originally built completely. Emergency hospitals remain ready every hour because healthcare systems require steady funding, regardless of how many patients arrive. Behind every hospital are thousands of professionals whose work depends on reliable public funding throughout the entire year. Education reaches millions of children because governments invest continuously in schools, teachers, classrooms, and learning resources every year. Classrooms function every day because education requires consistent investment beyond simply constructing school buildings across the country. Public safety depends on trained professionals whose salaries, equipment, and daily operations require continuous government financial support every day. Public transportation connects entire cities because operating massive transit systems requires long-term investment beyond passenger ticket prices alone. Looking across the city, you begin realizing taxes fund far more than deductions shown on your monthly payslip alone. Every government must carefully decide how public money gets distributed because national needs constantly compete for limited resources. Government budgets determine how much funding reaches healthcare, education, transportation, security, and countless other essential public services annually. Clean drinking water reaches millions because governments continuously invest in infrastructure people rarely stop to notice daily. Reliable electricity depends on enormous infrastructure, requiring constant maintenance long after power stations are originally constructed and connected. Bridges, highways, and transportation networks quietly support economic activity every single day because governments continue funding their maintenance consistently. Large public infrastructure projects require enormous investment that few private businesses could realistically finance on their own completely. Many public services continue operating every day without charging full costs because governments help finance their ongoing operation. Even peaceful public spaces require workers, equipment, and maintenance funded through government spending collected from taxpayers everywhere. Looking across an entire city reveals how countless public services quietly depend on one continuous source of financial support. If every country depends on tax revenue to function, why would any government accept collecting significantly less from anyone legally? You naturally assume taxes work everywhere the same way, until one simple discovery completely changes that assumption forever. Every country creates its own tax laws because every government makes independent financial decisions for its economy independently. One country may charge businesses significantly more tax, while another chooses to collect considerably less from similar companies. Individuals also experience different income tax systems because governments choose different approaches to collecting personal tax revenue today. Businesses rarely limit themselves to one country because customers, suppliers, and opportunities exist across many different markets worldwide. People travel internationally every day, and businesses often expand across those same borders to reach entirely new customers. Products frequently cross international borders long before reaching customers, connecting businesses operating across multiple countries every single day. One company can legally operate offices, factories, and employees across many different countries at the same time simultaneously. Money often follows products across borders because international trade naturally connects businesses operating in multiple economies together. International business usually involves multiple currencies because companies regularly receive and send money between different countries worldwide today. If one company operates in many countries, which country's tax rules should actually apply to its profits entirely? As companies expand internationally, they begin operating under several legal systems instead of only one national framework altogether. Some governments collect higher corporate taxes, while others deliberately choose lower rates to attract international business investment instead. Countries actively compete for international companies because attracting business often creates employment, investment, and long-term economic growth domestically. Governments don't simply collect taxes, they also compete globally to attract companies that generate future economic activity locally. Modern businesses regularly make decisions across borders because today's economy extends far beyond the boundaries of one country alone. Managing one international company often means coordinating employees, offices, customers, and operations spread across several different countries simultaneously. As businesses operate globally, money naturally begins moving across borders alongside products, services, investments, and international business activities daily. Products may cross several countries before reaching customers, creating financial relationships that extend well beyond national borders today. The world's largest companies rarely belong to one country because their businesses have become truly international over many decades. One business can legally exist across multiple countries, meaning different financial rules may apply at different stages. If every country creates different tax rules, could businesses legally choose where those rules benefit them the most? Imagine buying a phone because one ordinary purchase quietly begins a financial journey far beyond the store you entered. To you, the transaction feels finished, but for the company, the movement of money has only just begun. Your payment didn't simply disappear into one bank account, because large businesses rarely operate that way anymore today. The store collected your payment, but that store represents only one small piece of a much larger business. Thousands of customer purchases combine together, becoming revenue that enters the company's financial system every single business day. Revenue isn't simply stored because companies immediately begin organizing where that money belongs inside their global business operations. Large corporations rarely operate through one company because different parts of the business often belong to separate subsidiaries. Although customers see one brand, the business behind it often consists of many legally separate companies worldwide. Money sometimes moves between companies owned by the same business before reaching its final financial destination completely. A company's most valuable assets aren't always factories because names, designs, and technology also create enormous financial value today. When one company uses another company's intellectual property, payments known as licensing fees may legally be required instead. One customer purchase may quietly trigger multiple financial transactions long before the money finally reaches its ultimate destination. The money doesn't always stay where customers paid because companies regularly transfer funds between their own businesses internally. One subsidiary may legally pay another subsidiary because each company performs different responsibilities inside the larger organization. The brand customers recognize may actually belong to a completely different company within the same corporate family structure. Using a company's name or technology often requires licensing agreements, allowing payments to move legally between related businesses internally. Some internal payments are called royalties because businesses compensate other companies for using valuable intellectual property every day. Once approved, the payment can legally cross international borders within seconds through the global banking system every day. Large companies constantly manage money flowing between countries because international business rarely operates within one financial system alone. Above many subsidiaries sits one parent company responsible for coordinating the group's overall business operations worldwide together. Your original purchase may pass through several companies before finally becoming part of the parent company's overall financial results. Thousands of similar payments move internationally every hour, creating an enormous network of global corporate cash flow continuously together. Your single purchase now looks less like one payment and more like an entire network of connected financial movements. If money can legally travel through companies across different countries, Could taxes change somewhere along that same journey? Following the money eventually leads you toward one unfamiliar phrase appearing repeatedly across financial reports and international business discussions. Again and again, one term appears across different sources, making you wonder why everyone keeps mentioning tax havens. The same phrase appears inside books, suggesting this isn't internet speculation, but an established part of international finance itself. Your first surprise is discovering tax havens aren't secret organizations, but actual places recognized under international law today. A tax haven isn't hidden underground because it exists openly as another country or legal jurisdiction entirely. Like every nation, these jurisdictions create their own financial laws according to decisions made by their elected governments independently. Businesses crossing international borders naturally encounter different legal systems because every country controls its own financial regulations independently. Some governments intentionally design business environments that attract international companies from around the world through legal incentives. Businesses don't always establish companies where customers live because registration can legally happen in another jurisdiction entirely instead. International company structures are usually created by lawyers and accountants working within existing legal frameworks every single day. Everything you've learned so far suggests these structures aren't hidden because they're documented through ordinary legal business processes publicly. If tax havens are legal jurisdictions, what makes businesses choose them instead of operating somewhere else entirely? One important difference quickly stands out, because not every country chooses to charge businesses the same corporate tax rate. Some governments intentionally keep business taxes lower because attracting international companies becomes part of their economic development strategy. A few jurisdictions collect extremely little corporate tax, while others legally collect none under specific business circumstances entirely. Establishing a company there follows ordinary legal procedures, much like registering a business anywhere else in the world. These jurisdictions usually provide clear business laws, giving international companies predictable legal frameworks for long-term commercial planning and growth. Many businesses also value financial privacy because commercial information often contains sensitive details about ownership and competitive strategy internally. Large international companies often centralize ownership through one location, while continuing everyday business activities across many different countries simultaneously. Choosing one jurisdiction often simplifies international operations, rather than changing where customers actually buy products or services daily. Public reports frequently mention places like Ireland, Singapore, Luxembourg, and the Cayman Islands within international business discussions. Headlines often portray tax havens as mysterious places, but the reality is usually far more structured and transparent legally. Using a tax haven doesn't automatically mean breaking laws because legality depends entirely on how those structures are used. If these jurisdictions legally exist to attract businesses, what exactly happens after companies begin moving profits through them? Behind one familiar brand often sits multiple legally separate companies working together as one coordinated global business organization. The company at the top usually owns the others, making it known as the parent company legally. The companies below are called subsidiaries because they are legally owned or controlled by the parent company above. Each subsidiary often performs a different job, allowing one business to divide responsibilities across multiple legal companies efficiently. Large multinational businesses may own dozens or even hundreds of subsidiaries operating throughout different countries simultaneously together. Running a business and owning a business are often different responsibilities handled by separate companies inside one corporate group. Ownership creates a chain where one company legally controls another through shares rather than everyday business operations directly. The structure looks surprisingly simple because every company connects through clear ownership, instead of complicated hidden relationships behind them. As businesses expand internationally, ownership chains begin extending across borders while remaining completely legal corporate structures throughout the process. If parent companies own subsidiaries, who actually owns the parent company at the very top of the entire structure? Sometimes a company exists mainly to own other companies instead of producing products or serving customers directly every day. This type of business is commonly called a holding company because its primary purpose is owning valuable assets. One holding company can legally own businesses located across many countries, while remaining separate from their everyday operations entirely. Some companies exist only as legal entities, holding assets without employing staff or selling products to customers directly. A shell company isn't necessarily illegal because it can simply exist to legally own assets or investments instead. Another legal structure called a trust can hold assets on behalf of individuals, families, or future generations responsibly. International businesses often maintain bank accounts in different countries because their operations extend across multiple financial systems simultaneously. Money can legally move between these accounts because international banking networks connect financial institutions around the world every day. Ownership itself can cross borders because companies are legally allowed to own businesses in other countries too. The structure keeps expanding until one question naturally appears. Where does all the value eventually end up after moving? Sometimes a company's most valuable assets aren't products themselves, but the intellectual property legally owned somewhere else entirely. When subsidiaries use those valuable assets, they may legally pay licensing fees to the company that owns them. Those licensing payments are often called royalties because companies compensate one another for using valuable intellectual property legally. For one subsidiary, the royalty becomes an expense, while another company records exactly the same payment as income. As payments move internationally, profits can also move through the same corporate structure, using completely legal financial transactions. Instead of remaining inside one company, money may continue traveling through several connected businesses before finally settling elsewhere legally. International banks simply process these transfers because every participating company exists as a recognized legal business entity already. One company alone explains very little because the complete ownership network only makes sense when every connection becomes visible. Your original purchase has now become one small part of a carefully connected international ownership structure, spanning multiple countries. The real advantage was never one company. It was the entire ownership structure working together as one connected financial system. Two similar phrases appear repeatedly in financial news, yet they describe very different situations under the law today. Many people use these terms interchangeably, but understanding the difference changes how the entire financial system suddenly appears. Tax avoidance generally means arranging finances within existing laws to legally reduce the amount of tax owed completely. Using deductions, credits, or legal business structures may reduce taxes while continuing to follow the rules established by law. Tax evasion is different because it involves deliberately hiding income, falsifying records, or breaking tax laws intentionally instead. The difference isn't simply paying less tax because legality depends on whether the rules are actually being followed correctly. The law itself determines where legal planning ends and illegal tax evasion officially begins within every jurisdiction separately. Two businesses may reduce taxes differently, yet only one follows the legal requirements established by government regulations completely. If laws decide what remains legal, who actually writes those rules and interprets them when disagreements eventually arise? Large businesses rarely make tax decisions alone because accountants help interpret complex financial rules before returns are submitted. Lawyers help businesses understand how existing laws apply before important financial structures are created across different countries legally. Every major financial structure must satisfy legal requirements before companies can confidently begin using it for business. Governments continuously examine company filings because tax authorities ensure businesses follow the rules established under national legislation properly. Independent audits provide another layer of accountability by checking whether financial reporting accurately reflects business activities and transactions. When disagreements arise, courts interpret the law and decide whether specific tax arrangements comply with existing legal requirements. Court decisions often clarify uncertain areas, helping governments and businesses better understand how tax laws should be applied consistently. Tax laws continue changing because governments regularly update legislation as economies, businesses, and international financial systems continue evolving together. The question isn't simply paying less tax, but whether every step follows the laws governing that financial structure completely. After understanding company decisions, another question naturally appears. Why would governments create these financial opportunities in the first place? Countries don't only compete for tourists because they also compete globally to attract businesses and long-term investment capital. Winning a multinational company often means attracting future investment, technology, skilled workers, and additional business opportunities over many years. When international companies establish operations locally, they frequently create employment opportunities for thousands of people throughout surrounding communities together. Even before collecting taxes, governments often receive registration fees whenever new businesses legally establish companies within their jurisdiction. Foreign investment brings more than money because businesses also introduce jobs, knowledge, infrastructure, and future economic activity into countries. From a government's perspective, attracting international companies may sometimes create greater long-term value than collecting higher taxes immediately. No country makes economic decisions alone because every government responds to policies adopted by other nations around the world. When one country becomes attractive for business, neighboring countries often reconsider their own economic policies to remain competitive. Tax policy becomes only one factor because businesses also evaluate stability, infrastructure, skilled workers, and long-term economic confidence carefully. Investment naturally moves toward attractive opportunities, encouraging governments to continually improve their business environments through different legal strategies. Changing tax laws affects many connected outcomes, making economic decisions far more complicated than simply increasing tax rates everywhere. Eliminating tax havens isn't simply closing locations, because businesses and investment could legally relocate somewhere else instead tomorrow. The real challenge isn't one country or one company. It's understanding an interconnected financial system where every decision influences another. After understanding the structure, another realization appears, because every financial decision begins with ordinary human behavior and incentives. Successful decisions rarely focus only on today, because planning several moves ahead often changes tomorrow's financial outcomes completely. Businesses often think in decades instead of months, because preserving wealth usually requires consistent long-term planning rather than short-term reactions. Reducing unnecessary risk becomes a priority, because protecting existing wealth can be just as important as creating new wealth. People naturally protect valuable possessions because greater value usually encourages stronger efforts to reduce potential future losses completely. When several legal choices exist, businesses usually select the option, creating the greatest long-term advantage within existing regulations. Governments respond to incentives too, because attracting investment often strengthens employment, innovation, and future economic growth across entire nations. Businesses compare opportunities the same way consumers compare products, because incentives naturally influence decisions throughout every competitive marketplace today. Given multiple legal options, most people naturally evaluate which decision offers greater long-term value and security together. Protecting something valuable isn't unusual because people instinctively reduce risk whenever something important depends on their future decisions. The structure now looks less like tax planning and more like a system built around managing risk and ownership. Perhaps the biggest lesson isn't about taxes at all, but understanding how incentives quietly shape financial decisions around the world. The city looks exactly the same because nothing around you changed today, only your understanding of what happens behind it. Buying coffee still feels ordinary, yet you now recognize every payment may become part of a much larger system. The receipt hasn't changed, but your perspective has, because money rarely stops where a purchase first appears to end. Tax havens are only one destination inside a financial network connecting businesses, governments, banks, and countries together every day. The greatest advantage never came from hiding money because the real strength existed within ownership, structure, and legal organization. Every entity served one purpose, but together they formed an integrated international financial system operating completely within legal frameworks. Understanding the system doesn't change the city around you, but it permanently changes how you see money moving worldwide. If wealth follows ownership, structure, and incentives instead of borders, Where does the real financial advantage actually begin?